Welcome back, everyone. Today on the Joseph Carlson Show, while the market is going up in 2025, we have the S&P 500 doing well, we have the QQQ doing well, we have even the Mag 7 doing really well, except for one. Amazon stands alone as a company that's not performing well this year. In fact, as MarketWatch points out, Amazon is the worst performing of the big tech Mag 7 companies, and it risks falling behind in the AI race. So what's going on with Amazon? This is a company that, after all, is one of my largest positions. I own over 600 shares of Amazon, or roughly $133,000 of the stock. That's almost as much value as I own in Netflix. So Amazon has moved up to a massive position in my portfolio, one of the top holdings. We have articles here that it's falling behind in AI. Well, I don't believe that this is going to last long. And like I've said before, we have stocks that are doing really well, like Google, that have seen their day. Over the past 4 months, that stock is doing incredibly well. Now Google has moved up to a share price much more in line with its future potential. And we have Amazon sitting here still at $220 per share. Where does that leave us? Well, I believe over the next 5 years, Amazon has immense potential as a stock, potential to double. In fact, I believe that there's 5 basic reasons that Amazon stock is going to go up. And I'm going to outline my thesis, these 5 different reasons of why this may be one of the best buys today. Now, we also have news of the evolving drama of Jimmy Kimmel, ABC, and censorship. Over the past couple of days, Disney has decided to bring Jimmy Kimmel back on. The show aired last night in what was one of the most anticipated Jimmy Kimmel shows possibly ever. He was just fired and brought back on only a few days later. So a lot of people were interested in seeing what he had to say. What is he going to do in his monologue? How is he going to address this controversy? How is he going to address his previous comments? Well, we're going to be taking a look at it. I'll be showing some clips from the monologue. We'll be looking at how he's addressing it and how this affects Disney. We also have news on the topic of censorship that YouTube has previously banned millions of channels because of COVID misinformation. They are reversing a lot of that policy and allowing those channels to come back on. We'll be discussing that. And we have Mark Mahaney, an analyst that I believe is one of the best, explaining why he believes that Netflix, yes, Netflix is one of the best companies in the market today, and why he believes it's going to go up 20% from where it sits today. So we'll be looking at that as well. So as always, we have a ton to get to in this episode, and we kick things off with Amazon. As we see here from MarketWatch, they point out that Amazon is the worst performing stock in the Mag 7 year to date. The Magnificent 7 has been the dominant force in the market this year, but at least one of its members didn't get the memo. On Tuesday, Amazon became the worst performing Magnificent 7 stock year to date. The position was previously occupied by Apple, but a surge of increased investor confidence on the back of robust iPhone sales sent that stock into the positive territory for the year yesterday, and it crossed ahead of Amazon on Tuesday. So far, Apple's kind of been in that territory of not performing too well, and it makes sense why Apple wasn't growing revenue and the valuation was very high. But now even Apple's performing better than Amazon. Shares of Amazon have returned just 0.6% so far this year, largely due to investor concerns about the company's Amazon Web Services and the business of artificial intelligence strategy. In July, Amazon's quarterly earnings report showed 17.5% growth rate for AWS. It only matched investors' expectations instead of beating them. In contrast, Microsoft Corp saw its cloud business grow 39%, and Google saw its cloud business grow 32% in the quarter. Both of those rates exceeded analysts' expectations. So even though Amazon came in mostly in line, the other clouds grew so quickly, exceeding their expectations, that by contrast, it made Amazon look like a loser. And then to add insult to injury, we had the earnings call, where we had a chance for Andy Jassy to address the issue. Andy Jassy on the call failed to provide specific AWS guidance on the most recent earnings call, leaving investors uncertain about exactly what was going on with the business. And I'll add that Andy Jassy, when asked about why AWS is performing worse than competitors, he said that this is just a moment in time. That was the exact phrase, that it's only a moment in time. And then he went on for a multi-minute long explanation, 3 or 4 minutes, explaining all the things that AWS can do. Basically explaining how good of software it is, how powerful AWS is, all the different toolkits that it has. But that did not address investors' concerns of why Google Cloud and why Microsoft Azure are growing so much faster. So Andy Jassy did a poor job of addressing investors' concerns. So where does that leave us now? Well, if we look at Amazon, and we can take a look at the dip finder here on Qualtrim, we can take a look at the Mag 7. I've entered these stocks in, And if we just look left to right, we can see the worst performing to the best performing this year. Amazon is just teetering from the red to the green. Right now, it's barely up 0.29% on a year-to-date basis. Then we have Apple up 3%, Tesla up 15%, Microsoft is just crushing it at 21%, Meta at 26%, Nvidia at 27%, and then we have right here, the king, Google at 30% returns this year, and it's still headed upwards. So Google has been crushing it, along with many of these other companies. Amazon is being left behind. And this is part of the reason why investors are starting to turn their attention to Amazon. Many investors are concluding that with all these other companies doing so well and Amazon being left behind, maybe now it's an opportunity. And I believe that's just the case. So let's go ahead and take a look at Amazon and the 5 reasons I believe this stock is well prepared for the future, and it's certainly a buy today. First of all, I just want to address the whole issue of Andy Jassy's comments and him not giving a good explanation and the earnings call being bad for Amazon stock. There's many cases that we've had before where a CEO gets on an earnings call and says the wrong thing. CEOs are human. They're just trying to answer questions. They're not going to put everything perfectly every time. Andy Jassy is not perfect. And we've seen examples of this type of thing before. The ASML CEO went on the earnings call and he said, because of uncertainty with all the tariff stuff, we don't know if we're going to grow next year. Because if things go into the worst case scenarios, if we have lots of tariff challenges and trade restrictions, maybe that affects our company. Just by saying that, the stock dropped 10%. This is exactly when the CEO made that comment. Right there. So the stock dropped a huge amount in the following days and then continued to go down after those remarks. But look at the stock today. Without even a new earnings report, ASML has not only gone back up to before the CEO's comments, but now it's at all-time highs, nearing $1,000 per share. And the truth is, this type of stuff happens all the time. Not every CEO is going to pump this stock on the earnings call, but that doesn't mean that it's not a good deal. If we look at Amazon, we can look at this company, I think, in similar fashion. When I look at the response that Andy Jassy gave about the slower growth of AWS compared to its peers, I thought his response was not good. In fact, I thought I could give a better response or at least explain the situation more. First of all, when we look at AWS, keep in mind that this is a business line that we're supposed to be concerned about. Now, does this look like the chart of a business we should be concerned about? Last quarter growing 17.7%. With a trailing 12 months revenue of $116 billion. Not only is AWS bigger than any other cloud, it's almost as big as Azure and Google Cloud combined, but it's also growing near 20%. Now, it is true that Amazon Web Services didn't grow as fast as Azure or Google Cloud, but there are some key differences. First of all, Google Cloud is a fraction of the size of AWS, so you can grow a bit faster when you're a lot smaller. That's a very known thing. When you talk about Microsoft Azure, that one's a bit more complicated to address because it did grow faster in total dollars than AWS, even at a smaller size, which shouldn't be the case. And this is where Andy Jassy had the opportunity to highlight some unique aspects of AWS, and it's number one of why I'm bullish on Amazon over the next 5 years. I believe that Amazon is actually the most well-diversified and set up cloud in every single hyperscaler and every cloud company. And the reason why is because of the diversification of their customer base. The big reason that Azure grew at that astounding rate that it did was because of huge customers migrating from on-premise into the cloud. Microsoft does a lot of business with Fortune 500 companies. When they convince those businesses to move their workloads from on-premise to the cloud, you get massive, unexpected growth. So while that growth can be exciting in the short term, it's lumpier, it's less consistent, and it's not as much of an ongoing compounding growth over time. What Amazon has that's unique is over 4 million customers on AWS. They have vastly more. In fact, it's likely 4 times as much as Microsoft. When you look at that compared to even Google Cloud, most third-party estimates are that Google Cloud have around 1 million. So Amazon's size in customer base is immense. And although that means that they won't have any single quarter where they'll see massive, substantial growth, it does mean that you'll have a more diversified, more consistent, more compounded growth over long periods of time. Andy Jassy had the opportunity to highlight the distinctions and differences in not only just the growth quarter by quarter, but the diversification of customer base, the quality of growth, how much of the market in customers they've captured, and how those customers rely on Amazon because of the advanced tooling. This is all true. It's all backed up by third-party analysis, but it's something that Andy Jassy failed to highlight. But this will likely be a huge catalyst to Amazon stock over the next 5 years. We shouldn't be concerned about Amazon's AWS. That shouldn't be something that investors are frightened about. It's $120 billion of run rate. It's massively bigger than Azure and Google Cloud, almost as big as them combined. They have 4 times the customers, and they have operating margins that continually go up, and the operating margins are already at 33%. So it's massively profitable. This is not just a business that we should be concerned about, but it's a business that we should be celebrating and excited about. Even the AWS customer commitments, the people contracting to do business in the future, grew by 25%. Amazon has an excellent business here, likely the highest quality of all the cloud companies. To add on top of this, and again, this is just point number 1 of why I'm bullish of this company, is not only the customer diversification, the rapid growth, the huge scale that Amazon operates at, but we also have reports with semi-analysis, I've highlighted this before in depth, that Amazon is now going into unique hardware in combination with their software. So we already have the AWS software layer with all their toolings that they built out for the past decade, but now you have hardware. It's called Trainium, a new chip that's competitive with NVIDIA. It's not quite as good on all benchmarks. NVIDIA, of course, leads the market, but Trainium's being built specifically for Anthropic, the AI model that Amazon owns the majority of. So Amazon is trying to create this new vertically integrated partnership very similar to ChatGPT and Azure or Gemini and Google Cloud. Amazon's building its own vertically integrated system, and there are massive data warehouses that Amazon has invested a ton of money in that are coming online very soon. This should be a massive tailwind for Amazon's AWS. In fact, in this write-up from Semi-Analysis, they argue that Amazon's AWS will not slow down. In fact, not only is it not going to slow down, it's going to re-accelerate. Every single quarter, it should re-accelerate from 17% to 19 to 20 and so on. They believe that it will be above 20% revenue growth even at the massive scale because of these new data centers and this unique partnership. If Amazon's AWS continues to compound like it is, if they keep the margins where they are, this company will not only do well, but it will grow. The stock price will go up specifically as a result of AWS re-acceleration. So if that happens, which I believe there is a strong chance it could happen, I think the stock is going higher than 220. That's point number 1. Now we move on to reason number 2 that Amazon stock will double over the next 5 years. And this is a point that I've personally done a lot of research on. I've just done a lot of work on this, and I become increasingly convinced that this is the case. I believe strongly that out of all the companies out there, Amazon is uniquely in a position to benefit the most from robotics and automation, more than any other company, including Google, including Tesla. Let's go ahead and look at a couple of the reasons why. This is a write-up that I did a couple months ago. I published it to my Discord and Patreon, and I want to go over just a couple of the reasons outlined here. First of all, in order to find a company that can really benefit from robotics and automation, they need to have the talent to build robots. They need to have the tech talent and the skill set to be able to do that. So you need strong in-house tech talent. Amazon has developed a deep bench of engineers and scientists, from AWS cloud architects to AI researchers, capable of developing and deploying advanced AI robotic solution. Few retailers have comparable tech prowess. So Amazon is uniquely one of the big companies that has huge tech talent, more so than Walmart, more so than Costco. They're right up there with Tesla and Google. But then we also have a company that has uniquely large and complex operations. Amazon's business isn't simple online sales. It's an expansive logistics operation with hundreds of warehouses, transportation fleets, and real-time inventory systems. This complexity means that there's many processes that AI can optimize: routing, packaging, inventory management, etc. The gains from even small efficiencies scale across millions of transactions. Any margin efficiency is massive, and that's an important point here. We need to find a company in order to benefit the most from robotics and AI, a company that has high volume, low margins. Everybody talks about AWS as being the good business. Then you have Amazon's retail as being the bad business. And the reason why? AWS is at very high margins, retail is at very low margins. If you have operational efficiency driven by robotics and automation to lift up the margins of that lower margin business, suddenly Amazon doesn't have a low quality business paired with a high quality one. It has two high-quality businesses. Another point, and this is what I highlighted as the most important point. We need a company that has all these prerequisites: strong tech talent, large complex operations. But most importantly, you need robots to be able to replace what humans are already doing. We need a huge labor-intensive workforce. Amazon employs over 1.5 million people globally, including roughly 1.2 million in its fulfillment center warehouses alone. We already know that Amazon can build cars that drive themselves. It's called Zoox. They're literally doing that right now in Vegas. The Zoox vehicle is driving around with no employee, no one else in the driver's seat. In fact, it doesn't even have a driver's seat. So this thing is driving itself. Well, simple logic dictates that if they can do that in a busy city of Vegas, they can certainly make vehicles that can drive around your neighborhood, pull in front of your house, and eventually have a robot jump out and deliver your package. It seems a little crazy. I mean, it seems a little fanciful right now, but we already know that's the way things are headed. And again, the number of employees they have doing that are in orders of millions. They have 700,000 people working as delivery drivers and in their warehouses. All of these, virtually every one of them, can be automated to some degree. Now, there's always going to be some humans in the mix, so I have no illusions that Amazon's going to fire every employee, but we can certainly have a situation where robots are doing all this routine, manual, and repetitive work, while humans use more of a supervisory role. They fill in where robots may have got things wrong, or where they're stuck, where they're having errors or glitches. That's going to be the role that humans play in the future. A lot of employees today are doing tasks that are repetitive, low judgment tasks. And Amazon is still paying them $25, $30 an hour, paying for their college, paying for their health expenses. That's a very expensive price to pay for something that eventually a robot can do on a marginal basis for free, repetitive over and over again, and work all day. Not only can they work more hours, but they aren't paid health insurance. They don't need time off. They only need routine maintenance. Amazon spent $60 billion last year, a huge portion of that, in fact, the majority of it being specifically on these routine tasks. So Amazon has the opportunity to get incremental margin efficiency through robotics over the next 5 years. If that drops to the bottom line, which I believe it will, that is massive profits for this company. Keep in mind that right now, Amazon is not optimized for profits. If this dynamic shifts, where stock-based compensation continues to go down, the cost of employees goes down and salaries go down, while margins pick up and free cash flow picks up, we'll see a much more healthy, profitable company. And this robotics play for Amazon follows their same exact identical past of what they've always done. Just think about it. Amazon originally only sold their own items on Amazon.com. It was all stuff that they fulfilled. There was no third-party sellers. But then they said, hey, look, we have all these warehouses. We have this website. Let's make it so other people can sell stuff on our website as well. Now that's over half the sales. Take a look at AWS. AWS started as just servers for Amazon, but they said, hey, look, we have extra capacity. We could make it so other people could host on our servers as well, and we'll just take care of that for them. Now AWS is primarily a product for other people, not just for Amazon. You also have robotics. Robotics, again, will start the exact same way. Amazon has over 1 million robots working in their warehouses. They'll originally have them working for themselves. Even when they build autonomous robots, humanoid robots, ones that can walk around and deliver packages, they will initially be purpose-built for Amazon's own purposes, for delivering packages. But eventually, Amazon will have the technology down so well, they'll have been able to test it with their own products, their own services so well that they'll be able to sell them to other people. That's how it worked with AWS. That's how it worked with the online sales. That's what Amazon does. They build for themselves first. Then once they get it down, they sell it to the public. And I believe that will be the next step of Amazon. Now, number 3 of why I believe Amazon is a buy today and the stock is going to double over the next 5 years. I believe that it's good to invest in companies that have something called high lifetime value. Meaning companies where customers just use them every single day, every year, year after year after year for their entire lives. Companies that people just never move away from. Those are the type of companies I try to target. Ones like Netflix. Netflix is just a part of people's lives. Ones like Google, where they have YouTube, that's just a part of people's lives. It's never going to go away. You also have, of course, other ones like Costco. It becomes a routine part of people's lives. They go there every week of the year. Then, of course, we have Amazon, which I believe is becoming a bigger and bigger part of people's lives over time. All the evidence shows that. And part of that is because of their digital ecosystem, their overall value proposition, their subscription. Amazon has built the Amazon Prime subscription as a standard de facto membership for family households. Almost every household in America has one of these memberships. And that's because the value proposition is incredibly good. It's very difficult to pass up. For example, when we look at Amazon Prime actually has, you can just take a brief look at where they're headed with this. First of all, you get delivery benefits. Fast, free delivery. This is one of the biggest benefits, but I actually don't think it's the biggest benefit of Amazon Prime. I believe that right now, today, and in the future, the entertainment benefits outweigh the shipping benefits. You know that I'm invested in Netflix. I'm very bullish on Netflix, and I believe the stock is going to double over the next 5 years. Well, the second place winner, I believe, in this category is Prime Video. It's the first stop entertainment destination, offering customers a vast collection of premium programming in one app, available across thousands of devices. They're building out more key series. They're building out more movies. They're building out more long-term content. And this is a huge growth driver for the company long-term. People love content. They love being entertained. This is just another pull for the Prime membership. Then you have countless other benefits. Amazon Music. You get access to a free version of this, which is actually quite good for just being included. It makes it so Amazon Music Unlimited is much cheaper. You have Prime Gaming. This is something that they're trying to build out similar to Netflix. It hasn't taken root yet, but it's another value proposition. We have Amazon Photos, which is actually pretty incredible. Prime members get unlimited full resolution photo storage with 5 gigs of video storage, exclusive deals. They have a Prime Visa membership card, and so on and so forth. Amazon is aggressively building out their entertainment with deals with the NFL, deals with the NBA. They're negotiating for more sports rights and contracts with soccer. They're trying to do this across the board. Amazon is trying to win at media at the same time as winning in cloud. And most other cloud companies are not doing this to the same degree. This is a high margin portion of the company that continues to grow above 10%. Now, number 4 of why I think this stock is going to double in the next 5 years is simply the advertising business. Amazon is number 3 globally behind Google and Meta. Now, Google and Meta are kings of advertising, but in a different way than Amazon. Google and Meta are everywhere with their social media networks, all the social properties that Meta has. And then, of course, Google with YouTube and their search business. So they have advertising down. Those companies are doing great, but Amazon's taking a bit different of an approach. Amazon, of course, has their online retail business, number 1 in the world, and they're infusing a lot of that with sponsored ads. Retail advertising is still early on. This is something that's not yet highly optimized. Even though it already has super high margins, this is going to be a category that continues to grow. When we filter out everything else but just the advertising, this is growing near 20%. They're also advertising on Prime Video. That's probably the next biggest way. They're advertising on Twitch. They're advertising on all these different channels. And Amazon is getting better and more effective with their ads, just like Google and Meta did. I'll note that Meta and Google have grown their ad revenue for a year and years and years, far beyond what most people predicted. And I believe that Amazon is in the early innings of their advertising growth. It's growing at 20% today, and I think they'll be able to keep this up for long into the future. They have so many avenues of growing their advertising, and they're even making it so that advertisers on Amazon can now pay to have ads on Netflix. They're brokering these ads with their advertiser base. This is a very good position for Amazon to be in. And number 5 of why I believe Amazon is a great pick today is because of the logistics network. Logistics requires scale. It requires more volume. The more volume you have, the more products you're selling, the more things you're moving, the easier you can scale logistics, and at the more cost efficiency you can scale logistics. So in terms of cost structure, the biggest company wins in logistics. Amazon has the number 1 online retail store. They're selling comparable amounts to Walmart, and they're doing so with this massive logistics business. In fact, Amazon Logistics is so big now, they basically built out their own UPS and FedEx and DoorDash combined. It is incredible. And what they're doing with this is, again, like Amazon does, they build it for themselves and then they sell it to other people. And that's exactly what they're doing in logistics. We have news here that Amazon adds Walmart, Shopify, Shein to multi-channel fulfillment coverage, where they basically do everything in terms of logistics. And the big companies that they're adding here is Shopify, which is a big one. That's a big win for Amazon. Shopify previously tried to build their own Amazon fulfillment network, and they cut that out early. They decided that was a no-go. Way too expensive, way too much CapEx. Now they're relying on Amazon. They're becoming partners with them, along with Walmart, which of course is a huge win, and Shein. Amazon, meanwhile, is being extremely aggressive with this. They're planning to launch in, quote, every major manufacturing location. So Amazon's just going everywhere. They want to be the dominant, concentrated winner in logistics. And scale creates further scale with this. Remember, you need volume to do this on a cost-effective basis. Amazon has that volume. Amazon's dominant, unique foothold in logistics, which is incredibly costly and it takes a long time to replicate and build out, is another tool in their vast tool chest to be able to have excess returns over the next 5 years. It's another thing that they can leverage. So when I look at Amazon, this story of AWS growth, millions of customers using it, robotics and automation, making the company more efficient, their massive Prime ecosystem, the long lifetime customer value, the huge advertising business they're building, and the logistics network, I just love this stock. I think it's one of the best ones in the market. Now, having said that, it doesn't mean that it's going to go up tomorrow. We've seen this many times before. We can't control for short time trades and the fluctuations and volatility of a stock. But we can control when we buy a company. We can control ourselves of when we buy and when we sell. I've been using opportune times to buy Amazon stock. The tariff dip and when the company dips down for no good reason, I believe are great times to buy this stock. Right now, I have $133,000 of the company, $40,500 in gains, and I believe it's just getting started. I'd like to see this eventually become a $200,000, $300,000 position from gains lifting it alone. So I'm super bullish on it. I think it's going to do great, but we'll have to wait and see. There's no guarantees in investing. Anything can happen, but that's my thesis. Now, moving on, we get to the return of Jimmy Kimmel's show back onto ABC. We know about a week ago, there's a lot of controversy when his show was suddenly pulled after some indirect pressure from the FCC and the bigwigs at Disney deciding that what he said was both inaccurate and insensitive. They decided to pull his show. Now, this has caused a huge stir of arguments for freedom of speech or the responsibility of businesses, the differences between public broadcast radio and private channels, and so on and so forth. I covered the whole issue in a lot of detail in a previous episode that you can look up. But what's happened since then, in only a few days, ABC or Disney has decided to bring back his show. And with it, the return of Jimmy Kimmel. Now, a lot of people were waiting to know what he was going to say. In fact, this was probably the most anticipated monologue of the year. He was fired and rehired within a week. How is Jimmy Kimmel going to address this controversy? What is he going to say? It's a very interesting thing. Most people are curious about what he was going to say. Was he going to be apologetic? Was he going to correct things? Was he going to be more indignant and double down? What is he going to do in this monologue? So this is likely, I believe, one of the most anticipated monologues of the year. I think it's probably Jimmy Kimmel's most watched episode in probably the past 5 years. He really probably has more attention now than ever before. And I want to highlight how he responded to this controversy. And during the monologue, this is the part where he addressed his previous monologue that got him kicked off the air.
Hearing a lot about what I need to say and do tonight. And the truth is, I don't think what I have to say is going to make much of a difference. If you like me, you like me. If you don't, you don't. I have no illusions about changing anyone's mind. But I do want to make something clear because it's important to me as a human. And that is, you understand that it was never my intention to make light of the murder of a young man. I don't think there's anything funny about it. I posted a message on Instagram on the day he was killed, sending love to his family and asking for compassion, and I meant it, and I still do. Nor was it my intention to blame any specific group for the actions of what it was obviously a deeply disturbed individual. That was really the opposite of the point I was trying to make, but I understand that to some that felt either ill-timed or unclear, or maybe both. And for those who think I did point a finger, I get why you're upset. If the situation was reversed, there's a good chance I'd have felt the same way. I have many friends.
That was his basic address of the controversy. And there's a couple different ways to look at this. He didn't exactly say, I'm sorry. He didn't say those specific words. He didn't say what I said was wrong, but he did clarify. And I think that this is about as close to an apology you're going to get from Jimmy Kimmel. I don't think that he was ever going to come out and say, I was wrong, I apologize. But what I see here is a roundabout way of saying what I said was dumb. It's a roundabout way of apologizing. It's kind of a way of apologizing while trying to save face. You're not exactly saying the words, I'm sorry, but he's definitely walking back what he said. He's walking it back to a huge degree. He's trying to really correct and kind of give clarity to how he really feels about the situation. So I thought that this was about as good of a response as Jimmy Kimmel could give, given the situation. I think it sounded at least sincere. At the end of the episode, he also did more of a tribute to Erica Kirk.
A moment over the weekend, a very beautiful moment. I don't know if you saw this. On Sunday, Erica Kirk forgave the man who shot her husband. She forgave him. That is an example we should follow. If you believe in the teachings of Jesus, as I do, there it was. That's it. A selfless act of grace, forgiveness from a grieving widow. It touched me deeply. And I hope it touches many. And if there's anything we should take from this tragedy to carry forward, I hope it can be that.
So there's multiple mentions of this event. He's taking the tragedy a lot more serious in this return. So there you have him addressing this controversy, I think in about as good of a way as he could. He could have came out and just straight up apologized, but again, it's Jimmy Kimmel. I think he did walk it back, and he does seem sincere. We also have at the same time this continued theme of censorship. We have YouTube admitting that they banned thousands, if not millions of accounts for COVID-19 misinformation or election misinformation. So during that time period in 2020, people could post things on YouTube. If they deemed it as false or misinformation, they would ban your channel permanently. Now YouTube's reversing these bans. YouTube says, quote, "Today, YouTube's community guidelines allow for a wider range of content regarding COVID and election integrity. YouTube wrote on X that it will be a limited pilot project open to a subset of creators, as well as channels that were terminated under the policies that the company has since retired. Among the previously banned under those rules were the associate of the Deputy FBI Director, Dan Bongino. We have former Trump Chief Strategist, Steve Bannon. We have the Health and Human Services Secretary, Rob F. Kennedy Jr. It's not clear if those channels will be reinstated, but those were some of the biggest ones that were banned. YouTube also said it's no longer going to empower third-party fact checkers to moderate content and will continue to enable free speech on the platform. So in a lot of cases, the third-party fact checkers have been accused of being biased. They can say that this is not a fact when it's really just a political view they don't like. Therefore, these channels get banned. And therein lies the problem and why YouTube's changing its policy. In fact, YouTube is following very similarly the policy on X or Twitter today, which is a feature that will display information panels with links to independent fact checks under the video. If someone makes some crazy claim or something that's medically inaccurate or, some other inaccurate information, rather than just banning their channel outright, you'll have further context underneath. You'll have the counter argument right underneath the video. Overall, I think this is the right direction for Google to go, to reinstate these accounts, to allow people to express their opinions, even if they're wrong or they're misinformation or they're dumb. It's better than going down the route of someone unilaterally banning these accounts and making them so people can't see them. I posted on X that I believe it was the right thing for Jimmy Kimmel's show to return. That way the market can judge it, the free market. If you don't like Jimmy Kimmel, you don't have to watch him, just like these YouTube channels. If you don't like what these channels are saying, you can vote with your feet, with your eyes. You don't need to give them views. So in this case, I think it's better to have more information, more context, more debate, and less censorship, less top-down management, less banning of accounts or deplatforming people. Now finally, we get to a new appearance of Mark Mahaney, an analyst that I very much like. Mark Mahaney explains his thesis on Netflix and why he believes the stock is going to rise 20% from a share price of $1,200 per share. Let's go ahead and take a look at his thesis.
There was an anticipation in the trade year to date that we were going to have a heck of a strong content slate in the back half of the year. I think that's coming through, and I think there's a little bit of surprise in this drama that everybody's now loved, and it's the most popular movie, I guess, of all time, K-pop Demon Hunters. But you still have, Carl. Don't forget, you still got Stranger Things, and it's coming out in 3 batches. So this is going to keep you busy: Thanksgiving, Christmas, and New Year's. And then I think the content slate will just continue to get stronger. I think the next move in the stock is going to be based on them ramping up advertising revenue. I think they're going to do it, but this is going to be a long slog. catalog, and then also getting more and more into live events, including sports. And I think we're going to see that. I think Netflix is just going to become more crucial, more essential to households around the world over the next 2 to 3 years. It's a really good asset. You want to be long it. This is not an aggressive entry point, but if you don't own any, you should buy some, I think, and look for those big pullbacks to step in and take big positions. I like Netflix as a core franchise.
I'm actually surprised about how bullish he is. Here I've owned Netflix for so long, and when a stock just goes up and up and up and up, you get anchored to certain price points. You think, geez, am I really going to buy more of this company? But here he is, avoiding the anchoring bias. Even though Netflix is up 30 some odd % this year, it's up big last year, the year before, Netflix has been such an incredible performer, he believes there's more to go with this company. So in his thesis, he sees sustained 20% or greater earnings per share growth for Netflix over the next 5 years. Incredibly rapid growth from a high quality asset. And I, of course, agree. Netflix continues to be my number 1 or 2 position in the story fund. Now that's going to be it for this time. Hope you enjoyed. See you in the next one.